Good afternoon, everyone, and thank you for taking the time out of your busy schedules to join us this afternoon. My name is Peter Pham. I'm the Vice President for Research and Regional Initiatives here at the Atlantic Council, as well as Director of its Africa Center, and we're delighted to welcome all of you to this event on South Africa moving forward, a conversation with the Reserve Bank Governor, Lesetja Kganyago. We're pleased to host this timely discussion on South Africa's economic future with the Reserve Bank Governor in partnership with the Atlantic Council's Global Business and Economics Program. And before I turn the microphone over to my colleague, Bart Oosterveld, permit me to say a few words about the Africa Center and our growing body of work on the U.S.-South Africa relationship. The Africa Center was founded by the Atlantic Council's current interim chairman, General James Jones, back in 2009 with a mission to promote dynamic geopolitical partnerships with African states and to help shape U.S. and European policy priorities to strengthen security and to promote economic growth and prosperity on the continent. And South Africa certainly has for a long time been described as a strategic partner for the United States in Africa, but regrettably, the bilateral relationship has taken somewhat of a lower profile in recent years. To examine that trend and to help to correct it, we published a report last year, the very end of last year, Forging a New Era in U.S.-South African Relations, authored by Tony Carroll, here in the front row, who is with us, and with the aiming of rekindling that dialogue about the critical relationship with the U.S.'s largest African trading partner. Now, after the resignation of President Jacob Zuma and the swearing in of President Cyril Ramaphosa, the U.S.-South African relations have entered a new era, presenting opportunities for economic, political, and security cooperation. Nonetheless, some of the allegations of corruption and state capture during the preceding administration remain, with concerns over political interference in South African fiscal regimes, as does the reduced credit rating last year. But there's also optimism that the new president's business credentials, as well as the leadership of the governor at the Reserve Bank, will lead to a stable policy environment. And thus we're very pleased to welcome Governor Kganyago to discuss South Africa's economic policies, as well as his country's relationship with the U.S. at this pivotal time. Before turning it over to my colleague, Bart, I'd also like to acknowledge our welcome to Ambassador Malangu, Ambassador of the Republic of South Africa in Washington, and no stranger to the Atlantic Council here. So thanks for joining us and honoring us with your presence, Ambassador, and your colleagues. And now let me turn it over, microphone to Bart Oosterveld, the Atlantic Council's C. Boyden Gray Fellow on Global Finance and Growth and Director of our Global Business and Economics Program. Bart.
Thank you, Dr. Pham. Governor, Ambassador, thank you for your presence here. It's truly an honor. In a prior professional life, I had extensive opportunities to interact with the governor, and the word credit rating was just mentioned. I know we had many discussions over the years. It's good to see my friend Brian Keegan here as well. Thank you for coming. As Dr. Pham mentioned, I'm the new director of the Global Business and Economics Program here at the Atlantic Council. This program, in all honesty, and to put all my cards on the table here, has been focused in recent years very much on growth in Europe, because growth in Europe was a concern. I think we are pivoting to a research program that acknowledges that there are global and collective action issues at hand, and that we hope to benefit from the current environment of macroeconomic relative stability and growth driven by countries such as South Africa, to tackle some of these topics around infrastructure, around energy, around financial inclusion, and poverty alleviation, and the bigger topics of the day. And in that context, it is a great honor to welcome you, Governor. You are no stranger to Washington or to the spring meetings or the fall meetings for that matter. I've seen you around town many times. You and your leadership have stressed the importance of international institutions for solving some of these collective action problems that we face together, and we look forward to hearing your comments.
Thank you, Bart, for your remarks, and thanks also for reaffirming the Council's commitment in general and that of your Global Business and Economics program in particular to strengthen global prosperity. I have the pleasure to introduce my good friend, Atlantic Council's treasurer, Brian Henderson, who really helped pull this event together today. Brian has had a lengthy career in international finance and banking, and particularly in the challenging sub-Saharan African markets, including South Africa. He's founder of Henderson International Advisors and a longtime friend of the Atlantic Councils. And previously, Brian's held board and executive positions in a number of global financial institutions, including Chase Manhattan, Merrill Lynch, and it's thanks to the overlap of his career with that of the governor that we're able to pull off today's event. Brian's strong ties to the continent and to South Africa in particular are unparalleled, and we're delighted you're able to join us today. And without further ado, Brian, I'll let you introduce the governor.
Thank you very much, Peter, and welcome everybody. Good afternoon, ladies and gentlemen. It is indeed a personal pleasure and honor to be here today. It isn't that frequent that a treasurer of the Atlantic Council gets to introduce notable individuals from anywhere in the world, so I take this privilege very special. All I worry about are the finances of this place. No, everything's fine, but it's nice to be here. So it is indeed a very unique and special honor to be able to introduce my friend Lesetja Kganyago. And if you will indulge me, please, for just a few moments, I would like to share with you the first time I had the occasion of meeting Governor Kganyago, now almost 23 years ago. A much younger Lesetja was attached to the Department of the Treasury, and we coincided on the occasion of the launch of the inaugural U.S. dollar bond for the Republic of South Africa. And at the time, I was a senior banker for Africa attached to Merrill Lynch. And as is the custom of these sorts of things, one goes on a extensive roadshow, as we call it, to inspire investors to look at the credit and then hopefully buy the bonds. So we went off onto a trip across the country, and the South African delegation was headed by the then Minister of Finance, Mr. Trevor Manuel, the Director of the Treasury, Maria Ramos, and Lesetja's predecessor, 4 times removed, Governor Chris Stals. This was quite a contrast of history and personalities between the new and the old South Africa, converging together with a few very nervous investment bankers and skeptical and slightly curious institutional investors. Following almost a week of travel, including many monotonous and sometimes not so monotonous one-on-one meetings and a few group meetings, South Africa successfully placed $150 million in 10-year bonds, achieving many accolades and great receptivity, but more importantly, it was named the Sovereign Yankee Bond of the Year by the prestigious IFR. Our trip also forged not only the bond of friendship, but a lasting interest on both a personal level and obviously a professional level of world international finance for Lesetja. He got, I think on one occasion, he was thrust to go into Minneapolis to do a one-on-one meeting all by himself, and I'll never forget how nervous you were saying, I'm doing this alone and the minister's not with me. But we had to divide our forces to be able to touch upon the more important institutions at the time. But also, after a week of this, this was a time when it coincided with, among other things, the World Series. So Lesetja Kganyago is a diehard Yankee fan now, and I'm sorry for all you Nets fans. We were, at the end of the day, watching whoever was playing. It was Atlanta at the time, where the games were going through, but the Yankees won. I don't think they've done very well since, actually. But it was a time when, I guess, baseball was really of interest to you then, because it was only a distraction you actually had from everything else we were doing. In any event, that's how we started our friendship. Governor Kganyago is the 4th governor of the South African Reserve Bank since the fall of apartheid. He was appointed in 2014 following service as deputy governor, and prior to assuming responsibility at the Reserve Bank, he served as Director General of the National Treasury and Chief Director for Liability Management in 1996. He is a graduate of the University of South Africa and holds advanced degrees from the University of London, as well as Wits Business School and Harvard University. Long recognized as a dedicated professional committed to open and transparent dialogue in the setting of fiscal and monetary policy, as well as regulatory oversight, Governor Kganyago was recently appointed to the prestigious position as chairman of the International Monetary and Financial Committee of the Policy Advisory Board to the Board of Governors at the International Monetary Fund. This is a very big deal. He is replacing, I believe, the governor of the Central Bank of Mexico, and he has a very important voice at the fund, not least on a global scale, but also and importantly as representing the interests of emerging economies and the challenges of the global system. So we are in particular very, very honored and really pleased that you were able to carve out time from a busy week with all the other things going on this week in DC to be here with us at the Atlantic Council. If this recent appointment to the chair of the IMFC were not enough, Governor Kganyago was recently named Governor of the Year for 2018 by the prestigious journal Central Banking. And in their citation, permit me to quote, "For defending and enhancing the South African Reserve Bank's reputation as an independent and well-governed institution against all threats, despite a turbulent political and economic backdrop." It isn't often that we have such a distinguished speaker here from South Africa at the Atlantic Council. And we are all aware of the many challenges that South Africa currently faces today, both politically and economically. And we certainly also recognize, Governor, that you have here a very open and, shall we say, large group of goodwill of people who want to hear more about South Africa. We've all been following it for so many years, and we are very interested in hearing what you will say to inspire us on the prospects for the future of your country. Governor Kganyago, welcome. Thank you very much for being here.
Thank you very much, Brian Henderson, for those kind words. I had to check what this Atlantic Council is and why you would had an interest in me coming to speak here. And after going through and looking at your website, I had to say to my assistant, we better put a call through and speak to this man. Not that I didn't have enough information of what the council was, but it was also because I hadn't spoken to you for a very long time and I didn't know where to get hold of you. So thank you very much for that effort. And Ambassador, thank you very much for insisting that I must come and do this. I was sort of like torn because I was supposed to talk about South Africa going forward. But in understanding South Africa going forward, we've got to locate the South African economy within the context of what is happening with the global economy, one. And then secondly, then I would like to talk about how South Africa has fared in the recent times. And then third, I would like to talk about how South Africa would cope with the trend of normalization of monetary policy in the advanced economies. And then lastly, I would like then to pose the question, because you said South Africa going forward, in the context of all of these global risks, how resilient is South Africa, and how would South Africa fare in that context? Back to the global economy, there isn't a doubt that we are now in a sustained upswing in the global economy, with the global economy now expected by the International Monetary Fund to grow by 3.9% this year and 3.9% next year. It used to be that it was a pastime of the IMF to revise growth forecasts downwards. And now it seems to be, it is becoming fashionable that growth is surprising on the upside. And it has been so for the past 2 years, which in itself was a welcome development. But as the global economy's recovery became more broad-based, questions were also being asked about what are the risks that could actually hinder this global recovery. One of the risks that has come, and it's a hotly discussed and debated issue at the moment, is the rise of protectionism. Not just the rise in trade protectionism, in the words of my predecessor at the IMFC, what he also called finance protectionism. And we think that what the emergence of protectionism would do is that it could actually spark countermeasures from those countries that feel that they are put at a disadvantage as a result of the rise of protectionism in their trading partners. And this would actually take us back, because one of the key interventions after the global financial crisis, the very first summit of the G20, which was held here in Washington in November 2008, one of the key interventions was to restart global trade, because you had global trade slow down significantly, and a lot had to be done to restart trade, because trade is such an important component of global growth. And so the rise in protectionism, if it is not stopped, and you have these rising trade conflicts, this could actually undermine the undergoing economic recovery. The second risk to the global economy, which of course has to do with record high public and private sector debt. My recollection, the level of public and private sector debt as a percentage of GDP where it is now is at its highest since World War II. This had come as a result of a combination of factors. Firstly, because when the global economy slowed down and major economies actually went into recession, the natural response was to provide both fiscal and monetary stimulus to try and get the economy out of recession. And of course, the fiscal stimulus also meant that governments are borrowing significant amounts of money. Of course, it also meant that the monetary authorities responded by providing accommodation to get credit flowing once again. Result was that we had ultra-low interest rates, which brought us to the point where interest rates were so low that interest rate policies were actually being seen as being ineffective, and hence unconventional monetary policies were embarked by the major central banks. And of course, with this, what we had was that a lot of capital started to flow to emerging market economies. And as it flew into emerging market economies, a significant component of these flows was actually debt-creating flows. And so one of the concerns that is coming up now is not just that debt has risen globally, but that you have actually seen some of the emerging market economies and low-income countries piling up on debt. And on its own, the debt might still be sustainable, but the risk that is coming is that you have got a significant component of debt in emerging market economies that is denominated in foreign currency. And as unconventional monetary policies are unwound and interest rates start to go up in the advanced economies, currencies of advanced economies beginning to appreciate, the debt levels in domestic currency terms will rise and could actually become unsustainable. Of course, the flows and the ultra-low interest rates also created other risks. The third risk that we identify had been rising vulnerabilities within the financial sector. And whether you are looking at where emerging market bond spreads are, or whether you look at where bond yields are, it is very clear that this is a situation that has got to be unwound. The same could be said about the equity market. At some stage, these are bound to unwind, and when they unwind, what is going to be the reaction of the financial sector? Unfortunately, though, is that as a global community, we embarked on a process of regulatory reform because from the global financial crisis, it became very clear that the financial sector was undercapitalized and that it needed a different approach to regulation. And with that different approach to regulation, our attitude as regulators was to build a resilient financial sector that would actually serve the real economy better. We think that we have succeeded, but the test is still coming, and it is when a crisis sets in that we would know that indeed we had built a resilient financial sector. But from where we are standing, when we look at it, we think that we had built a resilient financial sector. And the fact that we had built a resilient financial sector has also begun to lead to a creeping in of complacency. Complacency among some of the policymakers who believe that maybe we have done enough and we should actually even begin to reverse some of those reforms, which in my own view would be a terrible mistake if you begin to reverse those reforms, because the system that has been built out of those reforms is yet to be significantly tested. But there is also complacency that comes from the regulated sector that in itself is also beginning to try and push back on the reforms, because now in this environment where things seems to be doing so well, the natural thing to do is to say that it won't happen again. And of course, the last risk in terms of the global economy has to do with the fact that these ultra-low interest rates and these loose global financing conditions had actually provided a cushion for policymakers, particularly those who are tasked with making political choices. And those who are tasked with making political choices had found the environment conducive. And in that process, because the environment was so conducive, difficult structural reforms were postponed. And absent significant structural reforms, we would not be able to sustain this recovery going forward and make sure that it is sustainable, because it is through these structural reforms that you actually raise the potential growth rates of the various economies. With that in the background, how well has South Africa done? South Africa entered the global financial crisis from a very solid macro-prudential stance. And I'm using macro-prudential as not in its most recent fashionable state, but in the following context, that when the global financial crisis set in, South Africa's macro balances would have been characterized as prudent macro stance. We entered the global financial crisis with a budget surplus. We entered the global financial crisis with a growth that was north of 5%. We entered the global financial crisis with a banking sector that was well capitalized, that was liquid, that was well regulated and was well supervised, and was able to withstand that global financial crisis. So when many countries in the developing world had to spend taxpayers' monies to try and restart their financial sectors, we didn't have to do that because our financial sector was actually well regulated. So as the global financial crisis deepened, what you actually had was that just as you had seen elsewhere, South Africa also began to provide fiscal stimulus to try and get the economy out of the recession. We entered the global financial crisis with debt to GDP ratios of just under 25%. And today, the debt to GDP ratio is standing at just around 50%. So debt to GDP ratio had doubled from 2007 to where we are today. The response was a good one. I should not tell you about the states because you are north of 100 here in terms of your debt to GDP figures. But the same story you could tell around the globe, that debt to GDP figures went up as policymakers attempted to get the economies out of a recession. But what that meant was that as the economy began to recover, we had to rebuild our buffers. We have started to rebuild our buffers, and if you ask any analyst of the South African economy, they would say that we were supposed to have started some 5 years ago. There are some people in the audience here who used to cover the South African credit from a ratings perspective. And I'm sure when they look back, they would say, yes, we think that that consolidation should have started some 5 years ago. More on that later. It took South Africa a long time to start growing once again, and the growth was actually a stop-start kind of growth. It is only in the past 2 years that we started to accelerate growth. So the growth outcomes for 2017 surprised on the upside with annualized growth of 3.1% in the fourth quarter of last year, which was the third consecutive quarterly growth rate above 2%. Still, growth was only 1.3% in 2017, below the world average and below the emerging market economy average, but still higher than what we had seen in 2016 and in 2015. And this growth, more importantly, and I know many of you know of South Africa as a commodity rich country. Yes, we are commodity rich, but what is different with the growth that we had seen now is that this growth was driven by the secondary and the tertiary sector rather than by the primary sector in that period. Of course, with growth having suffered from the global financial crisis, it meant that South Africa's already high unemployment deteriorated, and with unemployment standing at 27% at the moment, is not at a level that would enable us to tackle the scourge of poverty in the country, which is why the structural reforms then also become important. And in South Africa, these structural reforms got captured in a document that we called the National Development Plan, which spelled out the reform agenda that we had to embark on. Structural reforms are difficult, and as it happens anywhere else, when faced with the difficult choices of structural reforms, even those who are tasked with making the difficult political choices will tell you this is politically difficult. And you say, well, that is exactly why you are put in that place, because you must make those trade-offs. And South African decision makers in the policy space are not different from the politicians elsewhere, which would mean that they then looked at the cyclical policies to assist, and those cyclical policies are really in the realm of monetary and fiscal policy. But with the debt figures that I had given you, that meant that South Africa had limited fiscal space to continue to provide the stimulus from the fiscal side. And as a result, South Africa embarked on a process of fiscal consolidation that actually began in 2016, and it is now being sustained going forward. Well, I am a central bank, and being a central bank, I have got to also talk about inflation and say that the period that we had at the height of the global financial crisis, whereas inflation in the developed world was non-existent and the developed world was struggling to create inflation, and as central bankers had come to discover, it is much easier bringing down inflation than creating it. And South Africa faced a situation where we were faced with a typical policy dilemma. And the dilemma we faced at the time was that we had slow growth, and yet we had inflation that was elevated and was outside of our target. That meant that monetary policy could not provide stimulus in the aggressive manner that you had actually seen in the developed world. Well, that did eventually pay off, and inflation eventually was contained. Inflation slowed down, and the most recent readings in January and February have provided a reading that is below the midpoint of our inflation target range. Our inflation target range is 3 to 6, and the most recent readings are below the 4.5% midpoint. And our own projections as a central bank going forward show that we will remain within the target. There are still risks to that inflation outlook that could emanate from what happens with oil prices, what could happen with the exchange rate should, as monetary policy normalizes, and I will come to that as I draw this to a conclusion, and say then, how then would South Africa fare in the context where you have got normalization of monetary policy in the advanced world? And I think for us to understand this, we have got to take a step back and say, when the advanced economies embarked on unconventional monetary policies, what did we actually see? What we saw was that a lot of capital began to flow to emerging market economies, and South Africa was also a beneficiary of that. And with that surge of capital flows to emerging market economies, exchange rates appreciated, which prompted one Latin American finance minister to say that the advanced economies are engaged in currency wars. And what then the response of many of the countries was that, okay, we would use the time to try and accumulate reserves and mitigate the appreciation of the currency. Of course, the appreciation of the currency also helped in other respects, to the extent that correct choices were made, and that the fiscal stimulus that was provided through the investment channel rather than through the consumption channel. It meant that the capital expenditure program would be cheaper because there is a significant component of capital expenditure that is actually imported from elsewhere. Now, as policy is to normalize, and these unconventional monetary policies are being unwound, you should expect that exactly the opposite of what took place would happen, which means that as policy normalizes in the advanced economies, capital flows will either slow down or even reverse from emerging market countries. It also means that there will be a repricing of financial assets of emerging market economies. It also means that you will have a realignment of exchange rates. What you had previously was that the exchange rate of emerging market economies appreciated, and with normalization of policy, they are expected to begin to depreciate. And thus, what would then be the response? And the point here is that the channels are not that straightforward, they mixed. Because to the extent that policy in the advanced economies is being normalized, and it's being normalized because the global economy is strong, then a strong global economy is good for the emerging market economies. And South Africa, being a small, open economy, benefited from the global recovery, which is exactly what we began to see last year. And so the recovery that we also saw, besides the domestic factors that I had talked about, was that we saw South Africa beginning to report consecutive trade surpluses, which meant that we are benefiting from the recovery of the global economy. Of course, this realignment of exchange rates, to the extent that they lead to the depreciation of currencies of the emerging market economies, could lead to a resurgence of inflation. And how do central banks react to that? Our approach in South Africa has been and continues to be that we do not react to the first round effects of a depreciation or appreciation of a currency. We will only react to the extent that we think the depreciation of the currency would lead to a rise in inflation. With that in mind, let me draw to the conclusion and then ask the question: how resilient then is South Africa in the context of this normalization of policies? And I think that for me to give a better view of this, I've got to take you back to 2013, where South Africa belonged to a club we didn't join. We were just told we are a member of that club, and it was called the Vulnerable Five. And those Vulnerable Five was a group of countries that had high current account deficits, high budget deficits, had high inflation as well. So in 2013, South Africa had inflation of over 6%, outside of our inflation target range. We had the current account deficit of 6.8% of GDP. We had a budget deficit of around 6% of GDP, which meant that our twin deficits were equivalent to 12% of GDP. So when the Fed indicated at the time that they are going to unwind QE, there was this reaction in global financial markets, and South Africa was seen as one of those vulnerable countries. So where are we now, and how do we compare to 2013? Today, the current account deficit is not 6.8% of GDP. It is actually 2.9% of GDP, which means that if there is a reversal of flows, South Africa is faced with a lower financing requirement than we were at the time. The budget deficit is not 6% of GDP like it was then. Today, the budget is 4% of GDP and declining as South Africa embarked on a path of fiscal consolidation. Today, inflation is not above 6%. Inflation is below 4% at 3.8% today. And what this low budget deficit means is that should bond yields begin to rise as a result of the normalization of policy, South Africa will be financing a smaller quantum than it would have had to be financing in 2013, and thus meaning that South Africa becomes less vulnerable. Inflation is lower. South Africa does have a significant chunk of its debt indexed to inflation. We also do settle public sector wages related to where we think inflation will actually come at. And with inflation now lower, it means that the budget framework is less vulnerable than it was in 2013. But importantly, it means that should the risks to the inflation outlook that I spelled out materialize, it means that South Africa has got the breathing space within its inflation target, and thus the monetary policy response will not have to be as intensive as it would have otherwise had been if inflation was outside of the target. Importantly, is that South Africa has not just rebalanced its external accounts, but South Africa is now running a net international investment position starting from 2016, meaning that South Africa has got more assets outside the country than foreigners have assets in the country. In other words, South Africa is in almost a net creditor position. So should there be a reversal of flows, South Africa's net position would be able to absorb that to a certain extent and thus cushion South Africa against that external vulnerability. Let me close off by saying that all of these numbers are important, but there is something that have got to be brought to the bear when you talk about the resilience of the South African economy. And that has always been pointed out as our key credit strength. And it has to do with the strength of the institutions of our democracy. That the institutions of our democracy are robust, underpinned by a world-class constitution, and with institutions that are given independence within the constitution. These days, there are things that you might be taking for granted when you think the role that an independent judiciary actually plays. And South Africans, unfortunately, have also become litigious. When politicians disagree with each other in parliament, they run to the judiciary. When South Africans think that their rights are being trampled on, they run to the judiciary. And so it has become a very important pillar of our democracy. And secondly, is that South Africa has got a very robust and independent media, which digs in all the time, and sometimes they disclose information that you would feel should not have been disclosed, but the courts have always ruled in their favor and said that it is in public interest. And thirdly, is that South Africans had learned through years of fighting oppression that having a parliamentary democracy is one thing. There is something South Africans are good at, is to mobilize outside of parliament. So you have got a very robust civil society movement in South Africa, which is a very important protector of our democracy. And then, of course, there are institutions that, in terms of the constitution, are tasked with promoting democracy, from an independent electoral commission that has to ensure that elections are free and fair, to, of course, standing here in front of you, an independent central bank that is tasked with a mandate to protect the value of the currency, and that must act not just independently, but must act without fear or favor. Institutions of our democracy have been tested. There had been attempts to undermine those institutions of our democracy. There had been attempts to capture those institutions of our democracy. The institutions had passed the test with flying colors, and if there is anything, when I go around as a South African, that I stand up and I'd say that the one thing that has been very positive in South Africa in the past 5 years has been that our constitution has been tested and tested and tested, and it has proved to be resilient. That's my story from the South. South Africa is a robust democracy with institutions that protect that democracy. We have now a political leadership that understands the challenges that we are facing, and it just also so happens that the global economic environment is favorable. We are alive to those risks, and we have got no doubt that under the new political leadership that South Africa has, we can only become a better country.
You've laid out a very thorough case for the resilience of South Africa's economy, founded upon the resilience of its institutions, of its democracy, on its comparative macroeconomic policy vis-a-vis the advanced economies in the world. I'd like to take it one step further, if I may. One question, the prerogative of the moderator, before opening up to questions from our audience, and that is, how do you rate, or how do you put that in comparison, not just with the advanced economies, but also other African economies that are emerging, especially as the long-term investment prospects for South Africa, especially as other countries on the continent rise, pick up growth, present themselves as destinations for foreign direct investment. And notwithstanding the resilience that you spoke about of institutions and of policy, how do you rate South Africa's long-term prospects in that competition for investment?
We do not see the other African countries as competitors. We see them as partners. South Africa is a very important investor in many African countries on the continent. And the way in which we had positioned ourselves is that we are a gateway to the continent. So we have got the infrastructure, we have got the institutions, and quite frankly, if you have foreign direct investment coming into South Africa that just targets the South African market, I don't think you are going to have a very good business case to make. The business case you would make would be that you are going to invest in South Africa. You are not just targeting the South African market, but you are going to use the South African base to expand into the African continent. It is a process that South African companies themselves had played on the continent. Whether you looked at the telecoms companies, you look at the retail companies, and some of the manufacturing companies that are taking advantage of the continent. And it becomes important for us in South Africa because there is a significant difference between the quality of our exports to the US and the quality of our exports to the African continent. Today, Africa accounts for about 30% of South Africa's manufactured exports. And that becomes important because African economies tend to produce roughly the same things. We are commodity producers. And so South Africa distinguishes itself because we have got a manufacturing base. And so when we target foreign direct investment to come into South Africa, we are actually looking for companies that would want to use us as a base to go into the rest of the continent.
Thank you. Now, opening the questions, please wait for, there's a microphone, so please wait for the microphone. I would ask everyone to please identify yourself and your affiliation if applicable. In the back.
Thank you. Hi, Governor. My name is Marilyn Houston. I'm from South Africa, but I've lived here for a long time. My question is one that is probably sentimental, but also professional, in that the clients that I've been advising, I've been saying to them, invest in emerging markets, and South Africa, of course, is one of those. But I ask you this question around the inflation targets that you mentioned earlier and how you navigate that given the 27% in unemployment. Do you find that the social safety net programs are enough to help in terms of alleviating some of that? And how do you then balance between that 3.8% current inflation rate with the 27% in unemployment? Thanks.
Oh, do you want to take them one by one?
Up to you, sir.
Is there another question? Yes. Whilst I think the answer to the previous one.
Wise man.
Hi, Governor. Good to see you again. My name is Alex Damianu, CEO of Talleyrand Advisors. I used to be in South Africa with Oxford Business Group, and a few years ago I met with the governor, and he laid out exactly this fiscal consolidation. So it's really good to see it happen. And I truly believe the institutional stability of the Reserve Bank and Treasury in particular kept the resilience of the economy. But that's just it, resilience. Where is the growth going to come from when you have structural issues such as policy uncertainty, NDP and IPAP sort of conflict with each other, power deficit, when I was there was rolling blackouts, and finally structural unemployment. What can you do maybe through the banking system, through providing liquidity, access to credit to stimulate growth? Thanks.
Okay. And maybe take one more, and the gentleman.
Yes, my name is Guylain Geleza. I'm the country director for Lesotho at the Millennium Challenge Corporation. And my question is about unemployment, 27% in South Africa, and you say that you need some sort of a structural reform. I'm just wondering if you're thinking about that in terms of the region, because it is a problem in the SACU region. When you look at the data, Lesotho 28, and when you see Swaziland's similar, it's really a problem, and they are the highest in the world, actually. So is there a regional solution, or you're thinking about South Africa?
Thank you. Marilyn, the thing about the inflation targets that we talked about and unemployment, the truth of the matter is that before we introduced inflation targeting, unemployment in South Africa was 30%. And when we had economic growth going, we brought unemployment down to 22.5%. And we believed that the only way we could continue to bring down unemployment is through growth. But growth is not going to come from higher inflation. There might be a short-term trade-off between inflation and unemployment, but that is only in the short term. And the question that was just been brought by Gillian, which talked about unemployment being stubbornly high in the region, posed the question, does this mean this unemployment is structural? And any one of us will agree, yes, it is. Because if it wasn't, how come South Africa, when it was growing at 5.4%, could only bring unemployment down from 28% to 22%? So that talks to the structural reform. And of course, one of the things that South Africans do not want to talk about, and the reason we do not want to talk about is because it gets so emotive that I have decided I will spend my time talking about other things and not talk about it, is the issue of labor markets. And so you have got labor markets that are clearly not clearing. And I check in this country where you say that you have got unemployment below 4%, 4.5%, and yet wages are not rising. And then you take South Africa where unemployment is at 27%, and then people are still asking for wage increases of 10%. And clearly it is not related to inflation. And why I say it becomes emotive is because then when South Africans ask for a salary increase, it's not because inflation has gone up. They tell you there is inequality in this economy. Look at how much that one is earning. I surely deserve a bigger raise. So unless you then deal with the labor markets, so that labor market is clear, you will not sustainably draw these things. Of course, then there is the second aspect of South African labor markets, which of course that we can tackle, which has to do with the skills level of the South African labor force. Understand that this is a country which consciously decided that the largest proportion of its citizens will not be taught mathematics. And we get surprised that the skills base of the economy is that low. And so, post-apartheid, you had an education system that had to try and correct that legacy. Whether we have succeeded with it or not is a debate for another day. But you actually needed in the structural reform to go beyond the manner in which the labor markets are organized to what the education outcomes are, and ask the hard questions of whether the education system is producing the kinds of skills that the economy actually require. And that is what is at the heart of the discussions in the national development plan. There are other aspects which then link up to what Alex says, saying, where is growth going to come from? There are things that are so low-hanging that if South Africa does, growth just takes place. Now, if you want to dig stuff out of the ground, one of the places that is endowed with stuff you want to dig out of the ground is South Africa. We have missed the commodity boom twice before. And for the past 5 years, we spent time making it impossible for anybody to sink a new mining shaft. If you sink a mining shaft, you take 10, 15, maybe 20 years to turn serious profits. And in that period, you will be faced with fluctuating commodity prices. And if you wake up 5 years after you have started sinking your shaft to hear that the rules have been changed, you will think twice about sinking the next shaft. And so one of the things that the new Minister of Mineral Resources was tasked with was to take out the uncertainty out of the mining sector. Because getting foreign direct investment into the mining sector for South Africa is a no-brainer, because we have got these commodities and we know where they are. We are one of the best geologically mapped countries. We know roughly which minerals to find in which part of the country. And so clearing the uncertainty which has become very important. So the Chamber of Mines in South Africa asked its members questions last year between October and November. And they asked the question, if there is certainty about the regulations in mining, how much can you invest? No, we have identified where the minerals are. And when they asked all of them collectively, the investment came to 240 billion rand over the next 3 years that could actually be unlocked by simply removing the uncertainty with the. So I guess it's a long way of saying that some of the structural reforms are as simple as clarifying the rules of the game in as far as licensing in particular sectors are, and clarifying what the regulatory framework is with respect to particular sectors. And then you said that we had faced an energy deficit. No, we actually have an energy surplus at the moment. And do you know what? You were there. It's not because we completed those big power plants that we had been building. It's because after trying to complete those power plants, we realized we need the electricity now. And guess where the electricity came from? The sun, of course, because we have got such an abundance of it. And you know what? Government didn't even have to put money. The private sector, simply by clarifying the rules, went on to do the investments in the energy sector. So clearing the rules so that investment can take place actually meant that it would take place. I think they might be calling me at the IMF building, but let me finish off the question and then we take the. So the thing about the inflation targets, there's one more thing we have got to clear. The notion that says that the poor do not care about inflation has got to be condemned. Because you see, the poor do not have the wherewithal to protect themselves against rising inflation. And in South Africa, if you are a beneficiary of a social grant, understand that government can never give you an increase that is 10% or anything like that. We would give you 5, 6% or so. And if government then allows inflation to rise, that means government is eroding the value of that grant. And that is why we see as the Reserve Bank that it is our duty to contain inflation so that we can protect the buying power of the poor. You said I'm left with 2 minutes.
Yeah. He's giving the signal that I think we can do a very quick round of with Ambassador Gibbs.
Ambassador.
Han Gibbs, lovely to see you again, and congratulations on an incredible job managing the economy through very rough waters. Quick question, totally agree with you about settling uncertainty. The land conversation has entered a new moment of uncertainty into the conversation. If you could talk about how you see land reform playing out.
Thank you, Ambassador. And then two quick gentlemen. That's the one.
Thank you. Dan O'Flaherty, former director of the U.S. South Africa Business Council. I wonder if you could comment, you mentioned foreign direct investment with relation to the mining sector. I wonder if you could comment generally about the adequacy and composition of foreign direct investment into South Africa.
And very last one, Aubrey.
Sure, Aubrey Ruby, Senior Fellow here. My question is about financial technology, Governor. How is the Central Bank of South Africa looking at both cryptocurrency and cybersecurity issues in terms of protecting your assets and your information?
Thank you. Ambassador Gibbs, you know, there's one thing we are good at as South Africans. We can create uncertainty. The Constitution of the Republic of South Africa provides for a land reform, it provides for land restitution, it even also provides for land expropriation. And when I say to South Africans, do you know that the government has expropriated land? It says, no, government has never done it. It says, no, what do you mean? The biggest investment in the Gauteng area has been the Gautrain. And the Gautrain, for you to build it, you had to expropriate land. And there was a process that was followed. It ended up in the courts. It was a clean thing. Government didn't have to pay market value because the land was expropriated in public interest. Now, why do we stand on the rooftop and say we are going to expropriate land without compensation? Actually, the Constitution provides that you can expropriate land without compensation. When can it happen? You see, in apartheid, it happened that there were people who were dispossessed of their land to the extent that your land was taken from you and given to Ambassador Gibbs for free. When government gives the land from Ambassador Gibbs and gives your land back, they do not have to compensate him because he got it for nothing.
But the courts have ruled that to the extent that there were developments that took place, you got to be compensated for the development. This thing is a clause in the Constitution, is justiciable, it has been cleared by the courts. Why would South Africans climb on rooftops and say, we want to expropriate land without compensation? There is a constitutional mechanism, it's spelled out, it can be done. But we are South African, so so what I'm saying is that land reform in South Africa and any land expropriation in South Africa that will take place has got to take place within the constitutional framework, and the Constitution provides for it. Adequacy of FDI. FDI has gone into mining. It has also gone into manufacturing. We, as I had said, it's manufacturers who want to export elsewhere. I think that the biggest that you had seen had tended to be in the motor industry and motor components. We have now also seen it getting into retail and into the technology space, but it is still not enough as far as we are concerned, which is why the president actually on Monday made an announcement of a crack team that would have to speak to investors to find out what do they see as constraints to investing in South Africa so that those could be cleared. And the team is led by one Trevor Manuel that you know very well. And it also includes a former chief executive of a South African bank, Mr. Jaco Maria. And it's a team of well-regarded South Africans that you are familiar with, and you would actually believe what they are actually telling you. Fintech, and you said cryptocurrency. I don't believe there are such things as cryptocurrencies. There might be crypto assets or there might be crypto things, because these things that you call cryptocurrency, a currency must meet 3 criteria. It must be generally accepted as a medium of exchange, it must be accepted as a store of value, and it must be a unit of account. And if it doesn't meet all of those 3, it is not a currency. That some people tend to accept it is neither here nor there. It doesn't make it generally accepted. Be that as it may, it is a reality. It is there. And our attitude had been to distinguish, because you framed it as fintech, we have distinguished between the technologies that underpin these crypto assets and the crypto assets themselves. The technology we had found to be technology that could be useful. And in South Africa, like it happens in so many other jurisdictions, we had embarked on an exploration with the private sector to experiment how distributed ledger technology could actually bring efficiencies into the national payment system. We brought all of our settlement banks. What that meant is that I had to give permission to bypass certain procedures and processes so that the thing could be fast-tracked. We have got a report that we are releasing on the 5th of May, and that report will then frame a national conversation on how we embrace on fintech. Apart from that, South Africa has leapfrogged. I've licensed 3 banks in the past year. All of those 3 banks will not open a single branch. They are all based on technology. And one of the banks is already starting with 8 million clients. And they make it very clear, if you do not have a mobile phone, don't bother to open an account with us, because the only way we are going to transact with you is through a mobile phone. Which then brings me to your next question, which says, how do you deal with cyber security? It's a vexing question. Across the road over there, when we discuss this thing, we discuss these things, but we must be honest. You can secure these things, and you can take all sorts of steps to protect your systems. The move now is no longer that you can have the system fully protected, but rather it's, if your system is brought down, how quickly can you recover? And part of it, to be honest, is that we sit there and we discuss these things, and we know that if there is a determined state actor who wants to bring down your system, they can do it. And so we sit and we talk about these things, and we do not want to tell each other that we do not trust each other, and we just have to go and do what you can to protect your system.
Mr. Governor, thank you very much for your candor, for your remarks, your willingness to engage. We certainly hope this is not the last time. We hope to have you again, and to that end, I have to fear not you, but Juanita out there, who is moving you to your next meeting. So with that, please join me in thanking the governor for being with us today. Thank you.